Today, we're really digging into Wells Fargo's third quarter 2025 results. We've got the earnings release, the presentation slides, quite a bit here. And it looks like there's more going on than just good numbers. Seems like a real transition story.
That's exactly right. Our mission today is to cut through all that data, get to the heart of it. We want to highlight the key strategic choices Wells Fargo is making,
Yeah.
especially around profitability, how they're using their capital, and what's happening in the different business segments.
Okay, so let's start with the headline numbers. They kind of set the stage. For Q3 2025, net income was $5.6 billion. That's up 9% from last year. Pretty solid.
Very solid. And that flows right into the earnings per share. Diluted EPS hit $1.66. So that's a bigger jump, up 17% year over year.
Wow. And revenue.
Total revenue came in at $21.436 billion, also up about 5% from Q3 24. These are the kinds of numbers that prompted CEO Charlie Scharf to talk about momentum. He mentioned leveraging their strong franchise. It definitely sounds like they feel they're moving past the cleanup phase.
Right, that momentum idea. Let's unpack that, starting with what shareholders often look at first, returns. The return on average tangible common equity, ROTCE. That tells you how well they're using shareholder capital, right?
Exactly. And it came in at 15.2% for the quarter, which is, quite good. It's up 133 basis points from the same quarter last year.
But the bigger news wasn't the 15.2%, was it? It was the target they set.
Yes. That's the real aha moment here. This signals a major strategic shift. They came out and announced a new medium-term ROTCE target range, 17 to 18%. That sounds ambitious.
It is ambitious. I mean, for a bank this size, that's pushing into pretty elite territory. It tells you they believe the big transformation work, the operational fixes, are largely done. Now it's about maximizing profit.
Okay. But to hit those kinds of returns, you'd expect expenses to be tightly controlled, maybe even falling. Looking at the report, though, non-interest expense actually went up 6% year over year. It hit $13.846 billion. How does that square with aiming for 17-18% ROTCE? Yeah, that's a good question, and you need the context. That increase included a pretty significant one-off item. There was $296 million in severance expense booked in the quarter.
Ah, okay. Restructuring costs.
Exactly. That severance cost them about 7 cents per share. So if you sort of mentally back that out, you can see that the underlying efficiency drive is likely still happening. But this charge masked it a bit. It did push their efficiency ratio up slightly to 65% from 64% last year. A short-term blip, likely for longer-term gain.
Makes sense. So besides managing operating costs, what about the capital side? That seems like the other big lever here.
Absolutely. And this is probably the most significant strategic shift we're seeing. It's about capital deployment. Their Common Equity Tier 1 ratio, the CET1 ratio, which is that core measure of financial strength.
Yeah, the buffer.
Right, the buffer. It was 11.0% under the standardized approach. But here's the key. They're now actively managing it down. They've set a new target range of 10% to 10.5%.
So they're saying they have too much capital buffer.
Essentially, yes. Or rather, they have more than they think they need for regulatory minimums and safety. Lowering that target frees up capital. It's a very intentional move. It says, we're going to put this excess capital to work, either earning more or giving it back.
And it looks like they did both.
They definitely did both. Huge share repurchases, $6.1 billion worth of common stock bought back in Q3 alone. That's nearly 75 million shares. Plus, they raised the common dividend again, up 12.5% to $0.45 per share. This capital optimization strategy, managing CET1 down, is really what fuels the engine to chase that 17-18% ROTCE goal.
Okay, so if the bank is deliberately running with a slightly thinner capital cushion, relatively speaking, and buying back stock aggressively, we really need to be comfortable with their credit quality. Is the underlying loan book strong enough for this approach?
That's the crucial check, isn't it? And the data, at least for this quarter, looks pretty supportive. The provision for credit losses, that's what they set aside for expected future losses, dropped quite sharply. It was $681 million, down 36% from last year. They cited generally improved credit performance.
And what about actual realized losses? The charge-offs?
Net loan charge-offs, or NCOs, were also down, decreased 14% year over year to $942 million. Now, within that, the consumer side is interesting. Overall, consumer NCOs fell.
Okay, that's good.
Driven by better performance in credit cards and home loans, which suggests the average consumer is holding up okay. However, and this is important, that improvement was partly offset because auto loan charge-offs actually went up.
Wait a minute. Auto charge-offs are rising, but we know they're pushing hard on auto loan growth. We'll get to those numbers. But does that suggest they might be taking on more risk in auto? to hit volume targets? Is that a potential weak spot?
That's precisely the tension to watch. You've hit it exactly. They're growing fast in auto and seeing slightly higher losses there, even as other areas improve. Right now, the overall strong credit picture kind of absorbs that. The foundation seems stable today. But the key question going forward is, can they maintain discipline as they ramp up consumer lending volume so quickly? It's a balancing act.
Okay, let's talk commercial real estate. CRE, especially office, has been a big worry across the industry. The report says total non-accrual loans were down 7% year over year, and that was mainly due to lower CRE non-accruals. That sounds positive.
It is positive. And drilling
Yeah.
down into CRE office specifically, which is, the toughest spot, non-accrual loans are still substantial, $2.45 billion. But, and this is the really critical point, that number actually decreased by $82 million from the prior quarter.
Decreased linked quarter. In office, how?
It means their proactive management, things like asset sales, getting borrowers to pay down debt, or just loans getting paid off, actually outpaced the amount of new office loans going bad in the quarter. It suggests they're actively working down the problem book, not just letting it sit there. Effective risk management in action.
And are they well reserved for the remaining CRD office risk?
It looks like it. The allowance for credit losses, the ACL, for their total CRE office book stood at $1.78 billion. That covers about 7.5% of those loans. And for the CIB part of the office portfolio, the coverage is even higher, 10.8%. So they've clearly earmarked significant capital for this known problem area. It seems contained and actively managed.
Okay, so credit looks generally stable, maybe with a yellow flag on auto growth pace. What about the overall balance sheet? Loans and deposits.
We saw pretty decent loan growth. Average loans were up 2% year over year to $928.7 billion. And importantly, that represented the highest linked quarter growth rate in over 3 years.
So the loan engine is definitely revving up. Where did that growth come from?
It was fairly broad-based, actually. Commercial and industrial loans, securities-based lending in the wealth unit, and crucially, those consumer categories we mentioned, credit card and auto loans, those were big drivers.
And deposits. Did they need to gather a lot more deposits to fund this?
Interestingly, no. Average deposits were basically flat compared to last year, around $1.34 trillion. This suggests they're funding the loan growth efficiently, maybe using existing liquidity or optimizing the deposit mix, rather than needing massive new inflows.
Right. Okay, let's transition to the specific business segments.
Right.
See where these strategies are playing out. Starting with wealth and investment management. WIM. This looks like a clear positive.
Oh, absolutely. WIM is humming along nicely. Net income up 12% year over year, $591 million. Total revenue up 8%. And the revenue growth came from both sides. Net interest income jumped 16%.
16% NII growth in wealth. How?
Mainly lower deposit pricing. They're not having to pay as much on client cash balances, plus higher loan balances within wealth. And then non-interest income was up 6%, mostly thanks to higher asset-based fees. Market values went up, so fees went up.
Makes sense. A good environment for wealth management. Total client assets hit almost $2.5 trillion, up 8%. Now, consumer banking and lending, CBL.
Yeah.
Net income also up strongly here, 14% year over year. This seems to be where that aggressive volume strategy is most visible.
Absolutely. You can really see the focus on those higher margin consumer products. Credit card revenue surged 13% year over year. That was helped by bringing a merchant services joint venture fully in-house, but also just higher balances and more spending activity.
And the auto number.
Yeah, the auto number is the one that really jumps off the page. Originations were up 115% compared to Q3 last year. They originated $8.8 billion in auto loans in the quarter versus just $4.1 billion the year before.
115% growth. I mean, that's not just market conditions. That's a deliberate, aggressive push for market share, right?
No question. That kind of growth is intentional. It ties directly back to needing higher yielding assets to hit that 17-18% ROTCE target. They've clearly decided that pumping volume into consumer credit, even accepting slightly higher potential risk like we saw in the auto charge-offs,
Is worth it for the returns.
it seems to be the calculation they're making, yes. They're leveraging that balance sheet stability we discussed to fuel the growth. It's a clear trade-off. Oh, and mortgages were up too, originations up 27%. And digitally, they keep growing, 32.5 million active mobile customers.
Okay, moving over to the institutional side. Corporate and investment banking, CIB. Results looked a bit more mixed here. Net income basically flat, down 1%.
Yeah, CIB was kind of a tale of two cities within the segment. Investment banking fees were very strong, up 32% year over year. That was driven by debt capital markets and equity underwriting picking up.
Okay, so deal making was good.
Right. And their markets division, trading, also did reasonably well. Revenue up 6%, driven by equities, commodities, FX, credit products. The drag really came from commercial real estate revenue within CIB.
Mm,
That specific line item was down 13% year over year, reflecting the broader slowdown and maybe some de-risking there.
got it. And the last segment, commercial banking. Net income there was down 12%. That looks like a bit of a red flag on the surface.
It does, but again, context is crucial. That decline and the 9% drop in total revenue for commercial banking was significantly impacted by an internal reorganization during the quarter.
Moving things around.
Exactly. They prospectively transferred about $8 billion in loans and $6 billion in deposits, mostly related to certain business banking customers, over to the consumer banking and lending segment, CBL. So the reported decline isn't really about core performance deteriorating. It's more about redefining segment boundaries, probably to serve those customers better within CBL. Internal housekeeping, essentially.
Okay, that makes sense. So let's try to synthesize this. If you're listening, what's the big takeaway from Wells Fargo's Q3? We've definitely seen this shift, like you said, from cleanup mode to a more aggressive pursuit of profit. They seem to be using the benefits of past efficiency work. They mentioned that $15 billion gross expense save target they've been working towards.
Right, from 2021 through 2025 estimated.
And using that breathing room plus optimizing capital to really drive returns.
That's the core narrative. The entire quarter is built around this theme of maximizing capital efficiency. They have credit, relatively stable, though we flagged that auto growth. They're lowering the CET1 target to free up capital. They're setting very ambitious ROTCE goals, 17 to 18%. And the way they plan to get there, it seems, is by aggressively growing in higher return areas, particularly consumer credit like cards and auto.
It feels like they've laid their cards on the table. The strategy is clear now.
It is, which leads to, I think, the key question for you to ponder going forward. Given this explicit strategy, lower capital ratios, aggressive ROTCE targets fueled by rapid growth in consumer lending, how sustainable is the current level of credit performance? They are making a calculated bet. They're betting the higher returns from this growth push will more than compensate for any potential uptick in future credit losses. The real tension to watch over the next few quarters is, where does that balance settle? How far can they push the growth before that calculated risk starts showing up more significantly in the loss provisions or charge-offs? That's the balancing act.
A really interesting dynamic to track, a perfect thought to leave things on. Thanks for joining us for the deep dive. We'll catch you next time.